Chapter 10, Measuring a Nation's Income. This lecture is on measuring a country's income with a focus on gross domestic product, GDP. Our goal is to understand GDP and its significance in evaluating economic performance. GDP is a key economic indicator representing the total income earned by everyone in the economy and the total expenditure on the economy's output of goods and services. It is crucial to note that in any economy, total income must equal total expenditure. This balance occurs because every dollar spent by a buyer translates into a dollar of income for the seller. We also revisit the circular flow model from Chapter 2. This model illustrates the interactions between households and firms within a closed economy. As we expand our scope to include the government and the foreign sector, we move to an open economy perspective. This broader view encompasses households, firms, government, and foreign entities interacting within the market for goods and services. Gross domestic product, GDP, is defined as the market value of all final goods and services produced within a country over a specific period. To avoid double counting, it is important to differentiate between final goods which are sold directly to consumers and intermediate goods which are used to produce final goods. For example, eggs sold directly to households are final goods, whereas eggs sold to a baker for cake production are considered intermediate goods. GDP focuses solely on domestic production and is typically reported quarterly and annually. Developed economies usually provide these reports quarterly, while developing and underdeveloped economies often report annually. Gross national product, GNP, differs from GDP by including income earned abroad by domestic residents and excluding income earned by foreigners in the domestic economy, with the difference known as net factor payment. For example, income earned by American citizens working overseas is included in US GNP, but not in US GDP, whereas income earned by foreigners working in the US is included in US GDP. The national income account identity, or the GDP equation, is given by y equals C plus I plus G plus NX, where y represents GDP, C is the total consumption spending, I is the total investment spending, G is the total government spending, and X is net exports, that is, exports minus imports. The components C, I, G, and NX are the primary expenditure elements that make up GDP. For further exploration of US GDP and economic indicators, you may find the following resources useful. To access the trajectory of US GDP reported by the Fed data source, you can view this data by visiting the link provided here. To view a range of economic indicators related to the US state and federal budgets, visit the US Debt Clock website given here. Let's now examine a table that includes the dollar values of GDP and its components, GDP per person or GDP per capita, and their respective percentages. By summing up the values of C, I, G, and NX, you can get the total value of GDP. For example, in the United States, consumption spending C accounts for 68% of GDP, which is the highest proportion. Investment spending I, government spending G, and net exports NX also contribute to the overall GDP. It's important to note that the proportion of each component can vary significantly between different economies. For instance, in China, investment spending I takes the highest proportion of GDP, accounting for 45%. This variation highlights how different economies allocate their spending differently based on their economic priorities and development stages. In analyzing historical GDP data, we observe cycles of expansion and recession of US GDP trajectory. Notable examples include the Great Recession 2008 to 2009 and COVID-19 2020 to 2021. These cycles consist of peaks, recessions, droughts, and recoveries, collectively known as the business cycle. Now we're going to discuss the methods used to measure GDP. 1. Expenditure approach. This method calculates GDP by summing all spending on final goods and services in an economy. Consumption spending C. This includes all household expenditures on goods and services. These expenditures are categorized into durables, for example, automobiles and appliances, non-durables, for example, food and clothing, and services, for example, intangibles such as medical care and haircuts, and spending on education. Note that purchases of new housing are not included in consumption spending. Investment spending I. This refers to spending on capital goods that will be used to produce other goods and services in the future. This includes business capital, for example, business structures such as factory and office buildings, equipment such as computers, and intellectual products such as software and chip. Investment spending also includes residential capital, for example, landlords' apartment buildings, and homeowners' personal residences, and inventory accumulation, for example, stockpile goods. Government purchases G. This encompasses all spending on goods and services by local, state, and federal government. It includes salaries for public sector employees such as army and school teachers and other purchases, but excludes transfer payments such as social security benefits and unemployment insurance benefits because they are not the product of goods and services produced. Net exports NX. Net exports are calculated as the difference between exports and imports. Exports represent spending on domestically produced goods by foreigners, while imports are spending on foreign goods by domestic residents. Here is the exercise. Let's walk through how to calculate GDP using the expenditure approach. We're looking for C, I, G, NX, and GDP. Step 1. Consumption spending, C. Add all household purchases, excluding new housing. C equals $1,800 plus $1,655 plus $305 equals $3,760. Step 2. Investment spending I. Include new housing, capital equipment, inventory changes, and new structures. Do not include depreciation. I equals $560 plus $250 plus $345 plus $300 equals $1,455. Step 3. Government spending G. Include salaries of government workers and public works. Do not include transfer payments. G equals $1,555 plus $600 equals $2,155. Step 4. Net exports NX. Foreign purchases of domestically produced goods minus domestic purchases of foreign goods. NX equals $60 minus $170 equals negative $110. Step 5. Add it all up for GDP. GDP equals C plus I plus G plus NX equals $3,760 plus $1,455 plus $2,155 minus $110 equals $7,260. We can also calculate GDP and related measures using the income approach. Here is how it works. Gross National Product, GNP, equals GDP plus income by domestic residents earned abroad minus income by foreigners earned in the domestic economy. Net National Product, NNP, equals GNP minus losses from depreciation. National Income, NI, equals NNP minus statistical discrepancy. Personal Income, PI, equals NI minus retained earnings minus indirect business taxes minus corporate income taxes minus contributions for social insurance plus interest income plus income from transfer payments. Disposable personal income, DPI, equals PI minus personal taxes minus non-tax payments. Note that retained earnings is the income that corporations earn but do not pay out to their owners. Indirect business taxes, for example, sales taxes. Contributions for social insurance, for example, social security taxes. Interest income is the income that households receive from their holdings of government debt. Income from transfer payments, for example, welfare and social security. Non-tax payments, for example, traffic tickets. In this exercise, let's calculate national income measures using the income approach. Step 1. Gross National Product, GNP. GNP equals GDP plus income earned by citizens abroad minus income earned by foreigners here equals $210 plus $10 minus $6 equals $214. Step 2. Net National Product, NNP. NNP equals GNP minus depreciation equals $214 minus $8 equals $206. Step 3. National Income, NI. NI equals NNP minus statistical discrepancy equals $206 minus $2 equals $204. Step 4. Personal income, PI. PI equals NI minus retained earnings minus indirect business taxes minus corporate income taxes minus social insurance contributions plus interest paid to households plus transfer payments equals $204 minus $9 minus $10 minus $11 minus $25 plus $9 plus $58 equals $216. Step 5. Disposable personal income, DPI. DPI equals PI minus personal taxes minus non-tax payments equals $216 minus $55 minus $12 equals $149. Let's test our understanding with a few quiz questions. Question number 1. Sam bakes a cake and sells it to Carla for $10. Woody pays Diane $30 to tutor him. In this economy, GDP is what? Here we can just add up the payments that Sam and Diane have earned out of their services as baking a cake and tutoring at the amount of $10 and $30 respectively, which equals to $40. So the answer is D. Question number 2. After graduation, an American college student moves to Japan to teach English. Her salary is included as what? Since this American college student earns her salary in Japan, it's either that her salary is included in Japan's GDP or US GNP. So the answer is B, only in Japan's GDP. Question number 3. Which of the following does not add to US GDP? A. Boeing manufactures and sells a plane to Air France. Since Boeing is a U.S. company, their production sits in the U.S. land, so it is U.S. GDP. B. General Motors builds a new auto factory in North Carolina. General Motors, or GM, is a U.S. company, so again, their production that sits in the U.S. land, it is U.S. GDP. C. The city of New York pays a salary to a policeman. This is the service conducted in the U.S. city of New York. It is U.S. GDP. D. The federal government sends a social security check to your grandmother. This payment is a transfer payment, and it cannot be included in the GDP because it is not a product of goods and services produced in the economy. So the answer is D. In this section, let's delve into how GDP is valued. Nominal GDP is valued at current prices and is not adjusted for inflation. Real GDP is valued at constant prices and is adjusted for inflation using a base year's prices. GDP per capita. When we take GDP and divide by the population, we obtain the GDP per capita, also known as GDP per person. This metric provides an average economic output per individual, and it helps to understand the standard of living and economic well-being of the population. GDP deflator is a measure of price index indicator. Essentially, you take the nominal GDP, divide by the real GDP, and then multiply by 100. The GDP deflator is one of several price index indicators used to measure inflation and changes in the overall price level of the economy. Other commonly used indicators include the Consumer Price Index, CPI, and the Producer Price Index, PPI, both of which are maintained by the Bureau of Labor Statistics, BLS. Additionally, the Personal Consumption Expenditures Index, PCE, is another key measure, and it is preferred by the Federal Reserve for setting its inflation target. Inflation is an important aspect to consider when analyzing GDP. Inflation rate is calculated as the percentage change in the price level from the previous period or month. Use the formula GDP deflator in time 2 minus GDP deflator in time 1 divided by GDP deflator in time 1 times 100%. Scenarios of inflation. Inflation is the positive rate of change in a general price level. Deflation is the negative rate of change in a general price level. Disinflation is a slowdown in the rate of inflation. Hyperinflation is an extremely high and typically accelerating inflation, often exceeding 50% per month. Recession. Having learned about GDP, we can now define when an economy is in recession. A recession is typically defined as 2 consecutive quarters of falling real GDP. During a recession, several economic indicators reflect this downturn. Real GDP declines, lower income, rising unemployment, falling profits, and increased bankruptcies. These factors combined indicate a significant slowdown in economic activity. Let's take on this exercise. Given 3 years of data for the prices and quantities of 2 goods, hot dogs and hamburgers, and using 2022 as the base year, we will compute the following: nominal GDP, real GDP, GDP deflator, growth rate of nominal GDP, and growth rate of real GDP. Nominal GDP. To calculate nominal GDP for each year, multiply the current year price of each good by its current year quantity, and add the values for all goods. Real GDP. To calculate real GDP for each year, use the base year prices. Multiply each base year price by the current year quantity, and add the values for all goods. GDP deflator. To find the GDP deflator, we take nominal GDP divided by real GDP times 100. Growth rate of nominal GDP. To find the growth rate from one year to the next, we take new nominal GDP minus old nominal GDP divided by old nominal GDP times 100%. Growth rate of real GDP. Use the same growth formula as above, but apply it to the real GDP values. We take new real GDP minus old real GDP divided by old real GDP times 100%. By following these calculation steps, you can arrive at the same answers I have provided here. Let's continue with a few more quiz questions. Question number 4. An economy produces 10 cookies in year 1 at a price of $2 per cookie, and 12 cookies in year 2 at a price of $3 per cookie. From year 1 to year 2, the real GDP increases by how much? To calculate real GDP, we use the price of the base year. Assume year 1 is the base year. Real GDP for year 1 is $2 times 10 equals $20. The real GDP for year 2 is $2 times 12 equals $24. To find the growth rate of real GDP, we take the real GDP year 2 minus the real GDP year 1 divided by real GDP year 1 times 100%. That equals to 20%. So the answer is A, 20%. Question number 5. If Mr. Tyson quits his job as a teacher to homeschool his own children, what happens to GDP? In this case, Mr. Tyson's income is eliminated when he quits his job. So there is no income generating to GDP. GDP will fall. So the answer is C. GDP falls because his market income decreases. Question number 6. Angus, the sheep farmer, sells wool to Barnaby, the knitter, for $20. Barnaby makes 2 sweaters, each of which has a market price of $40. Collins buys one of them, while the other remains on the shelf of Barnaby's store to be sold later. What is GDP here? Remember, GDP only takes the market value of final goods produced. Here we need to consider the market price of the sweaters. $40 times 2 equals $80. This represents the total value of sweaters Barnaby can produce, regardless of how many were actually sold. Therefore, the correct answer is C, $80. In this section, after an in-depth analysis of GDP, the question arises, can GDP be considered a comprehensive measure of economic well-being? It is widely accepted among economists that GDP is the single best measure of the economic well-being of a society. This is primarily because economies with larger GDP levels tend to exhibit better living standards, including improved healthcare and educational systems. For instance, countries such as the United States, Canada, the United Kingdom, Australia, and the members of the European Union, which have higher GDP per capita, generally display higher life expectancy, greater literacy rates, and more extensive internet access. Conversely, nations with lower GDP per capita often experience lower life expectancy, reduced literacy rates, and limited internet availability. While GDP is a useful indicator of economic activity, it has important limitations. It does not account for factors such as leisure time, the value of non-market activities, environmental quality, and the distribution of income across the population. To better understand overall well-being, we can look at the Human Development Index, HDI. Developed by the United Nations Development Programme, UNDP, the HDI provides a broader view of human progress by including health, education, and income indicators. Now, let's examine the table comparing 3 major economies, the United States, Germany, and China. Real GDP per person. The United States has the highest real GDP per person, followed by Germany. China's GDP per person is the lowest of the 3, but its economy is the second largest in the globe. Life expectancy. Germany ranks highest, suggesting better health outcomes. The United States is slightly lower, and China has the lowest life expectancy, though it has seen steady improvement. Average years of schooling. The United States and Germany show similar levels, indicating strong education systems. China trails behind, reflecting continued efforts to expand access to education. Human Development Index, HDI. Germany scores the highest on HDI, followed closely by the United States. China's score is lower, showing that economic growth alone does not guarantee high human development. This comparison helps us see not just economic output, but also quality of life and development in each country.